All right, well, in the interest of time, we'll go ahead and kick it off. Thank you all for joining us today. I can't believe we're in the middle of June. This is part of our CWDL webinar series on key mortgage topics for our clients and friends in the industry. Today, we're really excited because we have the opportunity to meet the warehouse bankers. We're excited to have Susan Johnson, Senior Vice President at Fidelity Bank, and Colin Luba, AMP, Executive Director, Credit Officer for Mortgage Finance at Texas Capital Bank. They will be sharing their insights with our own Dustin Pfluger, who is partner of mortgage banking. And they're going to just chat about some really important topics specific to relationships with your warehouse banks. Please feel free to put any of your questions in the Q&A area. We really encourage interaction. And if we don't get to any of them, we'll follow up with you. Other than that, let's get started.
Thank you, Casey.
Of course.
So okay, we'll get this kicked off. You know, one thing I did want to kick it off with and kind of address the first thing here. We obviously had Von Ringer that was supposed to be on this. That some of y'all may have signed up for, and due to obviously the recent news that I'm sure most everybody has heard of, with Comerica exiting the warehouse space, he has decided not to attend the webinar. So we will miss him, but obviously understand what's going on. So. But with that, I just want to preface we aren't going to be answering questions about Comerica or talking through stuff about that. So we will talk a little bit about counterparty risk and some stuff later in it, but nothing specific to Comerica. So if you guys do have specific questions about that, please feel free to reach out to your reps and whatnot, and they'll address that with you guys. And so I guess with that being said, I mean, we can jump into this, and I guess just how we normally kick these off. Let's just start kind of just high level trends of what you guys are seeing. Maybe I know the beginning of this year was different than probably now, so just recently what you're kind of seeing, what you're dealing with and handling within your client base, and we'll go from there. So
yeah, I think it's been obviously tough start to the year, especially the first quarter. We've seen a lot of our clients are making those changes to get themselves to where they're at a break even, but still kind of bumping along. Nothing that's like great shakes that's changing the trajectory of where they're going. I think probably the biggest thing that's really impacting them right now is this lack of inventory that's out there. I think that's even impacting them more than the rates. And so I'll talk to my clients and they'll have stacks of pre-qualifications on their desk, but no properties for these people to buy. As far as we've seen a little bit of rebound here in the spring, but again, nothing great shakes, and remains to be seen what's going to happen here for the rest of the year.
Yeah, certainly. No, and I just wanted to say, Dustin, obviously, thank you for allowing us to be a part of this. This is a great time to be having these conversations. And so hopefully the people that are listening in here will get a good feel for where your warehouse banks stand with regards to some of the things we're going to discuss today. And, I just want to preface housekeeping, the views that I have here really are my own, don't necessarily represent the views of my employer, but just wanted to make that clear to everybody as well. And, I bring a little bit different perspective to this from the credit side of things. Having sat in both seats on both the sales side and the credit side, hopefully be able to kind of talk to, not only what are you hearing from maybe some of your relationship managers, but also what are some of the insights into what the bank is doing on its side as well. Susan, I think you hit it spot on. Year to date, quarter one was pretty sharp. It was a sharp decline for a lot of folks. Q4 was I think worse than anticipated. Q1 I would say is par for the course in terms of where we are in a normal seasonal cycle. Kind of exacerbated by the sharp turn that last year presented. Q2, I think moderated to Susan's point. I think we're seeing a lot of clients realizing the cost-cutting initiatives that they've been working to try to put in place, which is great news. Top line, Margins continue to remain a question mark for a lot of people, but are seeing some moderation from the bottom line. The big thing that I'm seeing from my side, we're seeing obviously it saw quite a few profitability covenant violations leading up to this year. Q1 and Q2, starting to see some of those balance sheet covenants coming into play. It's interesting, from the turn of what was 2020, where leverage and maybe liquidity covenants were coming into play. Now you're seeing those liquidity and net worth covenants, starting to become something that we're having more and more discussions as people are getting closer to those numbers. So, that's kind of my early take on where we are so far in the year.
I would agree with you on that, Colin, because we don't tend to generally operate with a profitability covenant, so we haven't been seeing that quite as much, but we are seeing periodic trips of those liquidity and the capitalization covenants. And we're just needing to work through that with our clients. I have heard that some warehouse lenders are taking a look at those profitability covenants and maybe modifying them a little bit to reflect the current environment that we're all operating in.
Yeah, certainly. No, profitability covenants are something that, we have quite a few conversations around. Really the intent there is to understand, do you have a plan of action, right? Are you aware, are you being financially savvy and aware of your financial position? And, what are your steps? What steps are you taking to try to get back to compliance? And you're exactly right. Profitability covenants, if there is a justifiable way forward, we're going to find a way to work with you in terms of, resetting covenants or maybe setting certain loss allowances based on expectations of the company. But you're exactly right. We understand the market that our clients are going through. And, we're there to be an industry partner and work with our clients and have those conversations.
Yeah, I think that was a really important point that you made, Colin, is that these covenants are really in place to be conversation points. Right now, I don't think Colin wants to. I certainly wouldn't want to just simply cut somebody off if they breach that covenant. You want to talk to them, know if they've got a plan, because we want to be a supportive partner to those people in the industry.
So yeah, I guess on that, just a follow-up kind of thing. Like, so, going through the audits, we probably, 75% of our clients had either a violation or they had an amendment to their terms. So they didn't have a violation. I'm assuming those were the ones that were proactive in it. So just on the communication side of especially speaking to covenants and plans and stuff like that. What do you guys recommend, when to communicate, how to communicate, what to communicate? I guess just run with that.
My take on that, it's pretty simple. Be proactive, communicate early and often. I want to know that I can pick up the phone and have a good conversation with my client. And conversely, I want them to know that they can pick up the phone and call me. You never want to surprise your warehouse bank. That is one rule that I would definitely say, if you have anything to follow or take away from today, do not surprise your warehouse banks. Listen, we've done a significant amount of due diligence. It's hard getting a warehouse line set up. We spend a lot of time wanting to learn your business. And so, we're going to ask a ton of questions, but to that effect too, we want to see that our clients are aware of their business and their models and what is working and what isn't. And they have the wherewithal to know and understand that. So my big takeaway is early and often and be proactive in that communication.
I was going to echo an awful lot of what Colin was saying, early and often. That's the quick and quick and dirty answer, but it really goes into that whole idea of building a good relationship with this major provider of capital to your business. And you need to build trust, and that goes both ways. So you want to be transparent with your warehouse bank, but you should also expect them to be transparent with you. And And as far as how you communicate, obviously in person, virtual meeting, something like this, phone call is always preferred versus email. It's just difficult to build a relationship through email. Make sure you share the good and the bad. And if it's the bad, we want to get that as soon as possible, and make sure you share that bad before a warehouse bank like myself reaches out to you. And lastly, the one thing I would also say is if your warehouse bank reaches out to you, please respond, because silence can really hurt that relationship.
Yeah. And I think just for the record, I mean, that's what we have clients button up against stuff. I mean, that is what, we tell them that they want to know. I mean, it's much better to tell them to hide it because they are going to find out. And I mean, I think to your point, Susan, I mean, warehouse banks are arguably probably one of the most, if not the most significant, relationship provider, external party, whatever you want to call it, to mortgage companies. I mean, you provide them with their capital. So I mean, with their lines and stuff. So I mean, I think that is. So I guess just kind of the similar vein. I mean, when you are looking at clients, I mean, and maybe Colin, you can jump in first with your credit background, and Susan, with just your 25 years of experience. I mean, so I mean, starting off just with like from a credit perspective, I mean, what are you guys looking at? What are you looking at behind the scenes? What do what makes, and especially in a time like now, what makes a good client? That kind of thing.
Yeah, certainly. So, at the very top of my list, obviously, in this business, cash is king, right? So I'm going to first take a look at, what is the liquidity level that this company has historically kept in their business? And I'll just use some common industry standards, I guess, that are out there. Generally speaking, if you talk with a lot of the due diligence providers or people that are providing some sort of consulting work in the industry, 20 to 30% of your liquidity of your net worth and liquidity is generally a very standard benchmark. Alternatively, I've also seen it done in a way where it's based on a certain percentage of your average monthly production that you should maintain in liquidity. So we're going to start there first. I'm going to look at historical statements and try to tell the story behind the numbers, right? We understand, listen, this business has cycles, seasonality wise, not only throughout the year. So it depends on what statement we're looking at, but also in the business cycle that we're in now. So does the story fit the market? Does the story fit the narrative of the company? Is going to be a big place to start. In this current market environment, we understand there's going to be losses, right? There were very, very few companies that were not susceptible to some sort of a loss this past year. We get that. What are you doing to fix it, right? Or what are you doing to trend towards a break even or even a profitable position? What access to liquidity do you have? And then what is the general overall makeup of your assets on the balance sheet? And then conversely, on the flip side, what are your liabilities? I'm going to want to look at the size of your overall loans held for sale relative to your warehouse line balances. Do you have equity in the loans that you that you've originated that are sitting on your balance sheet? Do you have MSR assets? How are those being valued? Do you have loans held for investment or any other sort of what I consider maybe assets that may not be readily able to be turned into or converted into cash in a short time frame? My personal view is that mortgage banker balance sheet should be relatively liquid. There is value in the assets of the MSRs, and that is a very valuable asset. It's proven to be a very valuable asset over the last, certainly over the last year and into this year. But generally speaking, outside of an asset that is directly tied to the mortgage industry in some way, I want to generally see that balance sheet is going to be fairly liquid.
Mm-hmm. I'm going to echo an awful lot of what Colin was saying, and add to it a couple things. Character is something I think we also look at. Is this person who's sitting across from me someone I can work with, particularly in a difficult situation? And then as far as the liquidity and capitalization, we obviously are looking at that. And that can be kind of a sliding scale based upon the model. If you're doing things like securitization, mandatory delivery, servicing, those capital ratios, those liquidity ratios, probably higher than if you're somebody that is more on the broker to banker side. They're doing everything non-delegated. They're outsourcing all their fulfillment and processing. The other thing that we tend to look at too are the operational processes and procedures. I think a lot's been talked about that mortgage companies are manufacturing mortgage loans. We want to understand what that manufacturing process looks like so that you're preparing or you're producing a very high quality product at the end. And then we also look at the types of product and the product quality of what you've been producing. Product types, again, could, if you're getting a lot more into non-QM and reverses and some of those types of things that are not as much of a commodity, we might look to see more liquidity, more capitalization. And the one other thing I would add is make sure that whatever message you're getting from your warehouse bank, from the relationship managers you're working with, make sure that those people are aligned with the credit folks, because the relationship manager may be telling you all the way along, hey, looks good, looks good, looks good. But then when the credit comes in, they might have a little different picture.
No, definitely. That's a great point, Susan. You know, when you're talking with your warehouse banks, you know, you want to make sure that your relationship manager and your credit group are aligned, because they need to be able to tell the story to us and convey the story to us. You know, and conversely, we need to be able to have open and honest conversation about any maybe sort of issues or concerns that we see arising, and be able to relay that back to the client. And to the points that you spoke on, you're exactly right. Operational efficiencies of the business are always being touched on. You know, we want to see your manufacturing. Do you have issues with regards to repurchases or indemnifications, and how are you handling those? If you do have an MSR book, what are the delinquency rates on that? How are you properly managing that? If you've got loans eligibly bought out of pools, are you being prudent in managing those and working to get those numbers down? You know, conversely, on the flip side, how are you performing with regards to your warehouse lines? You know, are you, I will tell you, warehouse banks track as many details as we possibly can. We have a significant amount of data that we run analytics on, and KPIs and kind of performance metrics. You know, from the point where your loan is closed to the point where it is delivered to your warehouse banks, you know, i.e. Some of what we kind of call the wet to dry days, right? What does that period look like? How long is it taking you to get stipulations cleared off your warehouse on your loans that are being purchased by those investors? What are those steps, right? And what is your general overall average dwell time on the facility? Those are some other key points that we'll be looking at as warehouse banks, because, you know, while, you know, we may think that, oh, warehouse banks want loans to dwell as long as possible. No, the opposite is really quite true. We want those loans to move through and continue to move through the process in a smooth and efficient manner. If your dwell times are going up, you know, we're going to want to have a conversation around that, or understand what is going on within your business that is leading to that.
Exactly. I think, Colin, you make a really, really good point there. And this kind of gets into that relationship piece too. I know we're off topic here a little bit, but warehouse banks are tracking a lot of this data, particularly around how long it's taking on average for loans to turn off the facility. And so if you as an owner are sensing that it seems like some things are taking a longer period of time, maybe it's with a specific investor, contact your warehouse bank and say, hey, I'm hearing that it's taking investor ABC this long to buy these loans. Is that what you're seeing across your portfolio? Because while you as an owner are seeing one business, we're seeing many businesses that are using those same people. And so hit us up, ask us about that.
Certainly.
Oh, that's a great point. And we'll jump into the, probably a little bit more on that here in just a bit on counterparty
Yeah.
stuff. I had written down two questions I wanted to touch on a little bit. This is an interesting one that just came to my thought. What is y'all's, all the lenders out there have relationships with the relationship manager. I mean, how close of relationship do y'all recommend having with the actual credit people? I mean, do y'all recommend having relationships, know the credit people, not? I mean, what's that? I mean, there's probably some gatekeeping there too, I understand, but just like what, I mean, just a thought I had popped up. I just thought I'd ask.
You want to go first?
Yeah, I can only address it from what our experience is. And for us, the relationship and credit are one and the same. We're kind of housed together.
Got it.
So it's a little bit hard for me to address that one.
Yeah. So, and from my perspective too, I would say that generally speaking, at least in my experience, having the credit person involved and active in front of the client is something that is encouraged. Again, if you take a look at the different people that are involved in the process of getting a warehouse line up and running or renewing a warehouse facility, the farther we are away from the actual borrower themselves, the less information we have to go off of, which is ultimately, what goes into our credit package. And a lot of it is determined based on numbers that we're looking at, right? How does this client track relative to our experience in the industry in terms of a business model that is a correspondent or a wholesale? What are the margins that these guys are at relative to industry? What do their financials look at? I've got to be able to tell the story behind the numbers and determine and validate that the story that I'm being told aligns with the numbers, right? I think that there's great value. And I say this coming from both a sales and credit background. There is value in introducing the credit people to the client where it is appropriate, because that helps fill in a lot of the gaps that there sometimes could be if we're not able to get the story, or we may see something that maybe necessarily the RM did not see or did not relay to us as part of their opportunity assessment or credit package.
Mm-hmm.
Got it. Okay.
Great point.
Okay. And one last question I had written down over here just on the relationship side of things. So is there anything different? And I know this probably isn't happening all that much right now, but maybe it will in the next few months. But when you're all picking up a new client, I know the industry's small. I know, you probably have heard, of most people that come in your door. I mean, is there anything different y'all look at on new clients? Or is it all basically the same, whether it's new or old or whatever? I just curious.
Well, with old or I don't want to say old because
Existing. Let's
go existing.
That's a better word. Sorry.
With existing, you kind of have that track record. So it's almost like there's a little bit of a fast lane that you can go through. Whereas you've got a lot more of those gates to go through with a new client.
Got it.
Exactly right. The lift in terms of the barrier to entry to getting a warehouse line across the finish line is high for everybody coming in. The information being requested is identical whether you are seeking a small, $10, $15 million facility, or if you're seeking a $400 million facility. It doesn't, the requirements don't change. So once you have vetted that client, you feel reasonable in the information that you've received. To Susan's point, track record and a history of performance, not only from a financial and covenant and monitoring perspective, but also on the warehouse facility. Those are very big factors that play in for a renewing client relative to an existing client. And I will say that, you may have the best balance sheet in the world, But if your facility is historically performed in a very poor manner with regards to not being responsive or communicative, you know, some of the KPIs or metrics that we talked about in terms of dwell times or you know, properly addressing curtailments if you have any of those, or repurchases if that becomes something that you hit in terms of an aging perspective, or if overall there's just a lack of control that we can see in that facility. You may have the best balance sheet in the world, but that factor can certainly have a material be a material component of our decision whether or not to remain in the relationship.
Yeah, I think it goes back to that first statement where we also talked about one of the things we always look at is character. Is this someone I can work with? You may already have the relationship and are finding out, is this somebody I want to continue working with?
Yeah.
Perfect. Well, thank you guys. Okay, so we talked a little bit about it, but let's jump a little bit more, you know, kind of change a little bit of direction, go into kind of counterparty and counterparty risk. I know you guys play a role, I think, a lot of the times in approving counterparties, looking at different, you know, investors, other warehouse banks, you know, MI reps or MI companies. I mean, I guess just if one of y'all, let me see, Susan, if you want to jump in and kind of
Sure.
start just what you guys look at from the counterparty side and go from there.
Sure. Well, first and foremost, when we're talking about counterparty risk and evaluating counterparty risk, it's probably just as important, maybe even more so, to the mortgage company to have a good counterparty risk evaluation system. And so we want to understand, what is it that our clients or these prospects are going through in their counterparty risk evaluation. And one of the things I would say is it's really important to do your own due diligence. Don't simply rely on your warehouse bank to say that's an okay investor or that's an okay closing agent or MI company. Do that work yourself as well. And I think you need to look at those critical vendors. Like I say, the investors, your other warehouse banks, closing agents, MI companies, probably even LOS providers, subservicers, depending on what your model is. And you just want to make sure that those companies all have the capital and the liquidity to deliver on what they've promised. That's the biggest part of it.
You're exactly right, Susan. To echo and maybe expound a little bit upon that as well. You know, as a warehouse bank, I am going to encourage you to have multiple points of liquidity, not only from an investor perspective, but also from a warehouse perspective. You know, selfishly, I'd love all of your business, but from a prudent risk management standpoint, you need to have multiple warehouse lenders. And that's a very critical point that we evaluate and we look at when making our decisions. So, you know, not only access to liquidity via multiple points for a particular product, making sure that it can be sold to multiple different investors, but, you know, also evaluating the strength of those counterparties. You know, those companies are doing due diligence on you. And on the flip side, you know, we're going to be doing due diligence on them, and the client should as well. If we feel that, you know, a particular investor is showing some signs of stress, you know, we may decide to you know, curb away from or at least have some conversations around, you know, hey, there are some concerns, and having those conversations. I look at experience. I look at scope. You know, what is this counterparty, whether it's an investor or another warehouse bank, doing for me? Are they siloed in one niche area? Not necessarily a bad thing if they do it and they do it well, but it also goes back to the scope and the breadth of what they touch in the industry. So again, they've all got to be evaluated. They can't be evaluated in a vacuum, I guess, is the most appropriate way to say that.
Great point.
And then from a you know, third party in terms of title, settlement agents, you know, generally speaking, your warehouse banks might have something that they are doing to properly help vet those title agents, or conduct certain, have certain controls in place to help protect from, any sort of wire fraud or things of that nature. But to Susan's point, the onus is really on the mortgage bank that they should be doing that due diligence as well. You shouldn't just be relying on what, my warehouse bank has a process where they are properly vetting these settlement agents. That's great. Use it as a second backstop or a second level of protection, but that doesn't necessarily mean that needs to be substituted for what you should be doing yourself.
Perfect. I mean, we talked a lot there about, investors, MI, other warehouse lenders, you brought up settlement agents, stuff like that. I mean, any other ones we didn't touch on, any other key, other vendors, counterparties that, you guys kind of look to, anything else there that we missed just to kind of cover it all?
I think that next tier down, like we talked about, would be your LOS system. I mean, we always ask that question. We want to know. And generally we're going to hear all the normal ones out there, whether it be an Encompass or a Byte or LendingQB or one of those. But if it's one that I haven't heard of before, it might give me some cause for pause. Just because, can they produce things compliantly? What kind of support is there for that system? Because that LOS is so crucial to the running of a company.
Sure. And I would just add to that list too, hedge advisors.
Yes.
And I would also add any sort of servicing valuation companies that are being used, particularly mostly around your MSR assets. Those are two major areas that can have an overall significant impact on your business with regards to the models that they have in place, and are they performing in an adequate manner for you as the mortgage company. And so we want to know who you're doing business with. Are they firms that are well known in the industry and again have experience in what they're doing? And then does their logic or thought process or methodology or really their rationale make sense with how it translates to your overall financials?
Exactly.
Got it. Well, that was a perfect segue. It's like you almost teed it up here for me, Colin, on that. I mean, so speaking specifically, I mean, kind of getting into just a couple of like the accounting issues or financial statement issues or whatnot. I mean, you brought up, MSRs, valuations, interest rate locks. I mean, just, I guess specifically, I mean, let's start with MSRs here, because I think that's probably the one that's been, I don't know if it's the biggest issue right now or that's the right word, but specifically speaking of MSRs, I mean, I had like, I think the end of the year, we probably all kind of knew they were probably kind of a little bit overvalued, at least when you come up with a true fair value versus what they were on, market value. I mean, I guess, how do you guys look at MSRs and the value and the accounting side of them? I mean, you don't have to say specifically, but I mean, I guess I'll leave it there, leave it open for y'all.
Colin, did you want to start with that one?
Yeah, sure, I'll start. With regards to the MSR asset, generally speaking, if you're going to have MSRs on your books, we're going to want to see a copy of your value evaluations, right? And really, what I am looking for in developing the trends within your MSR books and portfolios is, how does that tie back to the accounting that you're doing on your financials, right? This past year, there's obviously been a pretty significant write-up in those MSR fair values, which for all intents and purposes is really masked maybe a lot of the core earnings that losses that some of these companies may be experiencing. To that note, we're going to try to isolate down to what your core earnings and or losses are. And that might mean taking a look at those fair value adjustments and pulling them out of a profitability covenant. It works both ways. Write-ups and write-downs in covenants we consider those on both sides. But trying to really isolate down to the core, I would say, a lot of times financials will net certain accounting line items together. I want to see what the breakout of those gross line items are. Additions, deletions, change in fair value, trying to get to, what is your capitalized MSR calculations? We want to see those, and we want to understand those, and are those tying to the financials? The second point I would make on the MSRs is, we realize that fair values are at probably historical mults. Some of the periods that we've hit here in the last couple quarters, there is a big difference, and there has been, between fair values on financials relative to prices that people get in the market. So there's a little bit of a disconnect there that we especially saw towards the end of the year. And we want to be conscientious of those. If your plan is to sell MSR assets and you've got them booked at a significantly high multi on your financials, we would expect to see that, you're going to maybe take some realized losses on, or not realized, unrealized losses and the adjustment write down, and to see those flow through to retained earnings and hit your, your net worth and your equity. So we just want to be conscientious of those. Again, it all goes back to, does the story fit the numbers that we're getting from reports and your financial statements?
Yep. I would agree wholeheartedly with what Colin is saying. And whether we're talking about interest rate lock commitments or MSRs, it's peeling back the onion a little bit. How are they getting to that value on the balance sheet? And then from the income statement side, how are those kind of non-cash items, which is change in the pipeline or change in MSR value, how is that really impacting your income statement, and almost isolating those things out so that we can get what's really like a true operational income statement?
Yeah, and I mean, I'll touch up a little bit on the piece there. Here, I feel like I can jump in a little bit here on the MSR thing, Colin, you brought up. But I mean, yeah, I mean, just a reminder that they are on the balance sheet at fair value, but fair value doesn't always mean market value in these instances. And it gets in a little bit, in depth on accounting stuff, but it's basically because it's a level 3 asset, which is considered not actively traded out there in the, public realm and market and stuff like that. So it has to be valued on a discounted cash flow. So they're valuing them based on, long-term cash flows and stuff like that. So you are, very right. I mean, I think this is an issue that, they probably maybe overstated on the balance sheet under correct GAAP, but if they were to go sell it, they may not realize that. So yeah, just wanted to chime in there a little bit where I could on that. So, I guess, I mean, Susan, you talked a little bit about pipeline. I mean, anything you wanted to add on the pipeline, Colin, there, like anything specific you guys look for, on the interest rate locks? I know that's in the past, it's been a bigger issue, I think. But yeah, I mean,
when the pipelines are smaller, it's not as not as much of an issue.
I mean, that's a very good point.
Exactly. Yeah, no, I think I would just say that, we're going to take a look at, from a trend analysis standpoint, does the value remain relatively consistent if there are changes, or that asset for some reason becomes outsized or more pronounced than it's been relative to the pipeline? We'll likely ask questions around that, and I would say more so from a help me understand the methodology that you are employing here and utilizing, so that we're aware of it. Is where I would say that our focus is. We want to understand it. It's not my job to tell you whether you are making the right call on your financials. I simply respond to understanding where you are with those numbers, and if I'm comfortable with it, okay. We're going to put risk protections and mitigants around some of those things, and respond accordingly to what you have.
Okay, perfect. I think the only really other piece I want to touch on the accounting, and I think this will be real quick, is, I mean, we obviously had probably arguably one of the biggest accounting changes this year since the fair value standards came into play in 2009, 8, 9, something like that. I mean, with this whole lease accounting thing, and I don't think it impacted y'all much because there's an asset and a liability associated now. But I mean, anything specific that, you guys did or saw on, on that stuff when you see this, big, new big old lease liability. I mean, for some of these banks, I mean, it could be very big, but they have 100 branches, it could be a massive liability, but there's also a massive
Okay.
asset there too. I mean, anything specific y'all were looking at that, or did you basically just kind of net them and ignore it, or thoughts there?
For the most part, we could net it and ignore it. As I mentioned at the beginning, we typically don't work with a profitability covenant, but for our liquidity covenant, a lot of times we look at working capital. And so if on the liability side, there was a significant portion that went into the current liabilities, then it maybe had an impact on the working capital ratio because the asset was staying in as a long-term asset. So you didn't have an exact match. In those cases, we just talked through that with our clients and then adjusted the working capital covenant accordingly. And that's how we really handled that, because we really looked at it as it doesn't have a real impact on the business. It's always been there.
Yeah.
It's just now it's showing on the balance sheet.
Yep.
Yeah, and I would agree with that. Our primary, we're going to first take a look. Do they generally net each other out? If they don't, I'm sure there are instances where they don't net each other out, but we're going to want to understand if they don't, why is that the case? I've not seen that yet to this point, where they haven't generally balanced each other out, but we may want to have some conversations around what that overall impact does to the financials. We from a leverage standpoint, it's not necessarily a concern at this point. Maybe had a different opinion on that in 2020 and 2021. But as it stands today, our primary, we're going to take a look at it, want to understand it through the notes to the audit. And then if there's anything that doesn't seem like it's aligning appropriately, have just a conversation to clear up and understand why.
And the only reason they wouldn't, I would imagine the only reason they wouldn't align significantly would be probably one of two. They either, had a lot of free rent in there and they're at the start of there. So, I mean, you take it and you basically capitalize it over the life of it. But they theoretically should have deferred rent on their balance sheet already if that was the case. And the only other thing I can think of is that they, for some reason, we had 1 or 2 clients this year that actually impaired some of that stuff, some of the assets, because they knew and they were doing it the appropriate way. I mean, these are, 1 or 2 really good, long-term CFOs that they, basically knew they had a lease liability out there, but they weren't using the asset anymore. They weren't in the office. I mean, they kind of shut it down, we're out, but they still had the liability and they, impaired that asset. So that asset was much smaller than the liability was, which again, it's probably a better thing for you guys to see anyway, if it, because they're doing it the right way. I mean, they don't have an asset they're using anymore, and they, at least being honest and showing them. Yep. So, so yeah, I mean, I guess, here we have, actually, hold on, we got a question. Let me look real quick what that is. Yeah, I guess before we jump into this other, into the M&A stuff we were going to talk about here at the end, we did have one question. Are there any additional considerations for warehousing e-notes? And then just kind of what the, the approval process for that is, and monitoring process and whatnot.
Yeah, certainly. So we have been active in the space from the e-note perspective for quite some time. That process, I'm not directly involved with what goes on in terms of setting that up. I will tell you, a lot of the challenge with e-notes to this point has always been making sure that every single party in the chain is able and eligible to be able to accept those notes. Warehouse banks themselves have to have their own e-vault. The title has to be able to initiate and originate, and you've got to be able to successfully deliver that and actually run through some pretty rigorous testing from a warehouse bank perspective in order to be eligible to get on any of the approved lists that Fannie, particularly Fannie requires with regards to testing and validation and running test loans through those vaults to make sure that it works. My personal take on e-notes, it's been something that we've been talking about for a long time. It's one of those topics that generally it feels like in transitions, whether we're transitioning into a pickup in the market through the business cycle or we're transitioning down, it always seems to come up in discussion and be talked about quite a bit. There's certainly some economics that have to make sense to be able to achieve the scale necessary to get the cost and justify the cost of the e-note. And generally speaking, at least within the last 3 or 4 years, 2019, I think was a big time where we were talking about it. And then 2020 hit. And I think everyone's focus diverted to just production, right? And and capture as much as we can. On the flip side, I saw those conversations starting to creep back up quite a bit early last year, maybe late 2021 into early 2022. But again, because of such the pronounced and sharp increase in rates that we saw last year, everyone's focus immediately diverted to, okay, shore up costs, bring things in, so I think we need to get into some sort of a market where it's pretty consistent. There's a lot of the technology that is out there now. It's really from a mortgage banker perspective, can I achieve the economics for the added cost of what I need to do to get it implemented? And that's been the biggest challenge that I've seen with a lot of folks is that the benefits don't necessarily outweigh the costs.
I would agree with you, Colin. We've been active in the e-note space, warehousing e-notes now for a little over a year, around a year. And I would agree that it seems like it's been kind of a start-stop process. Secondary market execution's getting better, but for a long time, there weren't a lot of outlets. And so you really weren't able to best X. I think it's improving a little bit. But one of the things that you have to do, as Colin alluded to, is there's a lot of testing that goes on all the way along the chain from closing through the mortgage banker, through the warehouse bank to whoever that investor is going to be. And then you have to take it back. And in addition, you have to have these agreements with the investors of who's going to do what. How is the control of the e-note? How is the location of the e-note going to get pushed through the system? Who's responsible for that? What role are each of these players going to take along the way? So there's some additional documentation that has to be negotiated out because the nature of the asset is different. In the paper world, a note is a negotiable instrument and it follows negotiable instrument law, whereas an e-note, it's a different class of asset altogether.
Okay. Well, that's that. Well, let's jump in. I mean, we've got 10 minutes or so left and, kind of just talk through, M&A, thoughts there. I mean, we can kind of run with it. I know we kind of, talk through in the planning phase, just kind of talking about, if you do merge and you merge with another Fidelity customer, what's the wind down process look like? How do you consolidate? Yeah, I mean, just kind of,
Right. And, I probably should have even mentioned that as one of the trends that we've been seeing this year is consolidation. Unfortunately, it hasn't necessarily always been two Fidelity clients merging. A lot of times it's been one of my great Fidelity clients going and getting acquired by somebody else. So in that case, I don't come out the winner. But my client does, and I guess by that token, I am a winner. At least that's what I'll tell myself. So just some of those things that you would want to consider. I think what everybody wants, whether it's a wind down of the company, an M&A situation, everybody really wants in these situations to be able to wind down in an orderly and compliant manner. You want to do it as efficiently as possible. And every transaction is different, but some things to consider, and most of this is going to be around acquisition, is have a plan for how you want to fund and sell your pipeline. Have a cutoff date for funding in your name. And then if you're being acquired, look to set up an arrangement with your acquirer that they'll purchase the loans that you've originated, or they'll indemnify the investors so that you can get your pipeline cleared out. I think cardinal rule, make sure you have multiple sources for your loans to go through. It's especially important at that point once you're kind of going through the wind down. You may want to consider consolidating your relationships. So what I mean by that is if you've got 5 warehouse lines, maybe you look at those relationships and go, you know what, I'm going to take it down to like 2 that I really can focus on. It'll just make it a little bit more efficient for you rather than managing 5 relationships, you're managing 2. And same thing with investors. If you've got 12, maybe you want to consolidate it down to 4 or 5 so that you've got enough outlets for your product. But again, you're having those people that you know you really can count on and work through this. You also want to consider about when you want to communicate your plans with your warehouse banks, your investors, and your employees. You may have restrictions on what you can communicate and when you can communicate. So you just have to kind of think about how that is all going to work. The most important thing, whether you do a wind down, you are going through an acquisition, give yourself time before you continue to burn through your capital. So let's say you're sitting there and you're kind of trying to figure out, I've been losing money. How much more am I willing to lose? Just give yourself a lot of time, make the decision and move forward with it. The sooner you make those difficult decisions, the better off you're going to be.
No, you're exactly right. I think you hit every single point there. I think the biggest takeaway from me is as soon as you are able to notify, particularly those parties that are going to be there with you until the end. You want to, and particularly on your warehouse side, you want to be able to notify them when you are able to notify them. I'm going to take a look at, do you have the appropriate, what I consider the runway, right, for a wind down, especially in a wind down situation? Is there going to be sufficient capital left in the business to see your pipeline through? Those dates become incredibly important in what you're telling us and what you're communicating, so that we're watching from our end the same trend take place. But yeah, we want to make sure that there's sufficient capital that will stay in the business to see it through until that pipeline is closed out. And that's incredibly important. From a consolidating facilities standpoint, and I'm going to take a little bit different, flip it a little bit from what Susan was talking about. And let's say that maybe you are the acquirer. Do you have enough capacity? Have that in place before, the last thing that you want is to get down to the point where you're ready to start absorbing additional volume and you don't have the capacity in place to do it. But telegraph that. Listen, your warehouse banks want to be there. They want to be your partner through the ups and the downs to support you and your business. But that really comes down to understanding your business. We ask questions because we want to learn your business. And if a warehouse bank isn't asking you questions when you're bringing things up, that is a sign that, I would necessarily say might be a red flag. So communicate and get those facilities or that capacity in place prior to that transition or that transaction commencing, because the last thing you want is something I don't have the ability to absorb either an MSR portfolio or a pipeline of new loans and not have the ability to maybe leverage some of that financing to be able to do those, if that's what your intent is.
Mm-hmm.
Perfect. Well, with that, actually, hold on, we got a question here. And then we can, I'll try to reword this a little bit so I don't put you guys strictly on the spot with this question. But when we're talking about terms with the clients, like how do you recommend the negotiation process to go? What's the back and forth? I mean, are you open to clients coming back saying, hey, we've got $50 million net worth. We don't need a personal guarantee anymore. I mean, just kind of your thoughts through, kind of, how do you recommend your clients talk to you guys about that, about terms of because I'm sure you'd rather them stay and negotiate terms than just say, no, we're done and walk away because, they're not happy with something. So I guess that's how I'll word it.
Absolutely.
So,
Absolutely. I think it is. It goes back to what we've been talking about quite a bit through here is the relationship and that transparency. I would much rather have a client come to me and talk about terms or something that's not working for them, because then we can work on that. I'd much rather have that than have them just harbor this bad feeling and leave. And I don't know why. And so it really goes into that great communication between client and warehouse bank, and just being very open.
Yeah, certainly. You're exactly right. I take a look at it and I like to convey that there are certain pulse checks along the way. And generally speaking, one of the first indicators there is volume on the warehouse line. If for some reason, you as a client feel that, there's a term that isn't maybe necessarily aligned, generally that first indication is, hey, something's going on with our volume. Maybe we're not getting our fair share of volume anymore. We use those as pulse checks. Hey, how's the relationship going? What are there any pain points? Let's talk through those. I would say that warehouse banks are open to negotiating and revisiting. I understand that there are times the market is not consistent; it's not stagnant. There's times where certain things make sense, and certainly now in times where we may need to be putting additional protections in place if things are not looking great, but we want to continue the relationship and grow with you. My biggest comment there is it's a two-way street. Generally speaking, right now I know that margins are tight, but you have to realize as well too that this is a relationship business, and it can't be transactional. If we're going to maybe give up in one area, we're going to be looking to get additional protections in another. Banks have net interest margins and that we need to be able to meet and achieve as well to stay in business. And it can't always purely be my rate needs to come down, a loosening of the credit structure. Yes, there's times where those things ebb and flow, and it's got to continue to remain that way. And understand that in certain cycles, it may not move in your favor in that area, but we're going to work with you, and we want to continue to be a partner there through all cycles.
Yeah, and I think, Colin, to your point, you hit it absolutely square on the head. It can be things other than just interest rate, file fees. It might be something about the type of reporting you're getting or the process for requesting fundings. Any of those things can really be looked at and talked about, and it all goes back to that open relationship and having that dialogue back and forth.
Well, perfect. Well, with that, I'm going to actually bring Casey back on to say, take us away. But I want to say, thank you guys very much, for doing this, jumping on. I mean, I'll have to say it's our first one where we've had competitors on, or friendly competitors on, and I think it went great. So thank you guys both for taking the time to do that. And so I guess with that, Casey, you can kind of, yeah, of course. So
yeah, tons of valuable information today, and really appreciate you both coming on, Susan and Colin. Great discussion as usual. So we'll have a recording that'll go out probably tomorrow. So keep an eye out for that. And then at the end of this, there's going to be a quick survey that'll come up. If you guys wouldn't mind just taking about a minute of your time to complete it, we're just trying to continue to bring you guys relevant information. So that's all. Thank you guys so much.
Thank you.
Thank you. Thank you
Have
guys.
a great day, everybody.
Have a great day, guys.
Bye-bye.
Bye.